You do not want to trade this with, well, I think this is going to happen, or maybe this is going to happen. No, this is a quantitative approach that we have, a math-based approach. There's no playing around with this. You do not want this to be subjective. You want it to be rule-based, a quantitative rule-based process, so you can duplicate the success week after week after week. So 106 weeks of just killing it on this trade. It's no longer luck. It's not luck. It's a systematic process. It's a quantitative process that we use to make money consistently, week after week after week. You can learn it too, but in this video, we're going to go over an amazing strategy that we teach here at Dorian Trader. We call it the 7DTE printing money strategy, or print money 7DTE strategy. Over the last 106 weeks, this has literally been like printing money for us. And I'm not using hyperbole here. We have won, and we have won, and we have won some more on this 7 DTE strategy. DTE means days to expiration. So this is a weekly strategy that we have created here at Dorian Trader that has just been phenomenal. In this video, we're going to discuss some of the details of this strategy and talk about how I have went over 106 weeks of winning on this strategy, starting with a small account and growing it. This is not a day trade. You do not need a huge size account to be able to do this strategy. You can start it with as simple as $5,000, and you can start printing money once you understand the process. We like to say once you can darn near teach the strategy, if not teach the strategy from our course, our 7DT course, then you're ready. Then you start off with 5,000. Even if you had $100,000, you start off with 5,000 until you learn the process. Once you get the process down, then you start scaling. You go from one contract to two contracts to three contracts and so forth. So I don't want to mislead anyone on this video. This is not a get rich overnight type of scheme. No, we're not about that. We are about teaching people how to trade successfully on their own, step by step. But we understand that the process is not just rolling out of bed and being able to go 2+ years of winning week after week after week. You have to learn the process. So in this video, we're going to break down the process. We're going to go over several steps you're going to have to understand. Number one, you're going to have to understand how to put the trade on. That is super important because that's what you can control completely. Once you put the trade on, you can control everything. And you can't control what happens after you put the trade on, but you have to know what to do after that. So number two, you have to understand how to read the trade. What is going on with the trade? Should you be taking profits? Should you be adjusting? What's going on? Is it in the green zone, yellow zone, red zone? Things that we teach here at Dorian Trader. Step number three, you have to learn how to adjust the trade. This is the most important part of the strategy, is understanding how to adjust the trade at a super high level. We talk about offensive and defensive adjusting. You have to know how to do it at a high level. And then number four, you have to know how to take the trade off. It's nuances to taking the trade off. It's not just pushing the free buttons and you're out of the trade, which is important, but you have to understand that sometimes you can't get out of the trade the traditional way. So let's jump into this and let's talk about how we set the trade up here at Dorian Trader. So as I mentioned, we start by allocating 5K for every contract that we start with. So if we're going to start with one contract, then we're going to start with 5K. If we were going to start with two contracts, then we're going to start with 10K. If we were going to start with three contracts, then we're going to start with 15K. And then if we were going to start with four contracts, we would start with 20K. And so forth. So it's a process to this. You have to trade this with the right amount of size. If you don't trade it with the correct size, you're going to run into issues. So yes, when you start with one contract, you're only technically using 1K to start with, right? And then 2K if you start with two contracts, and then 3K if you're starting with three contracts, and then 4K if you're starting with four contracts. What is the other amount? Why do we have that other amount set to the side? Well, we have that other amount set to the side so that you can have the ability to adjust. You're going to be able to make two huge adjustments by having contracts to the side. We call it having ammunition to be able to adjust. So this trade is super important to be able to manage the time within that 7-day window, that 7-day trading period. You have to manage the time correctly, and you have to manage your resources, your ammunition, your contracts that you have. You have to know when to add more contracts, when to not add more contracts, when to do a proactive adjustment, when to not to do a defensive adjustment, and so forth. Super important. Now, once you have figured out how much you're going to allocate to start the trade, and we encourage everyone to start with one contract. Regardless of how big your account is, we want you to start with one contract. Even if you had $100,000+, you start with one contract. Once you have determined how much you're allocating, and once again, that should be one contract if you're new to this, then you're going to go to what we call the straddle price. The straddle price, when you set up the straddle price, it is the expected move. It's kind of the back of the envelope, back of the hand type of calculation of the expected move. Every platform that specializes in options trading is going to have an expected move. Here on the TastyTrade platform, this is the expected move. So at Dorian Trader, we want to be uniformed. We want all members to kind of have the same starting point if they're doing the same type of trade. So in this example, we're recording this video right now on the weekend, so we have to use an 8-day. And we have to use an 8-day, but the concept is still the same. It's primarily a 7 DTE trade. Sometimes we do the trade with 6 days or 5 days. And sometimes you have to do the trade on an 8-day window. But the trade is normally, or almost 100% of the time, a 7 DTE trade. So we start off with the straddle price and we kind of round it up. So in this case, we have 144, right? We have 144. We times that by 2, and that gives us 288 points. We take that 288 and we add it and subtract it from the last price of the SPX, so plus or minus. And this is how we set up the trade. So, for example, I take that 288 and add 56.38. That's going to take us to 59.26. I just say 59.30. So we're going to go all the way up to 59.30, and we're going to do a 10-point wide spread. We set this up with a 10-point wide spread. This is step one of how you put on the trade. Then we're going to take that 288 and we're going to minus that from the 56.38. And that's going to take us down to 53.50. So we go to the put side here and we're going to start the trade at the 53.50. And that's going to be right here. And we're going to do a 10-point wide spread. So as you can see here, this trade is $85. We want to collect at least $100 after fees and commissions, because the goal of this trade is to make 1 to 2% every single week. So if you collect $100 off 5K, if you're using 5K to start that one contract, $100, if you win all of that $100, that would equal 2% in a week, which is awesome. But we're trying to make 1% initially. So if we collect $100, we're trying to win $50. $50 divided by 5,000 is 1%. So we're trying to get the 1% unless we have to adjust. If we have to adjust, then we're going for the 2%, the 3%, even 4%. If we have to adjust, we're trying to go for a bigger amount during that 7-day period, but only if it's safe. And most of the time it will be safe. You don't want to put too much stress on your account trying to go for bigger numbers. But if you never have to adjust, you're going to get out of the trade with at least 1% on the capital allocated to the trade initially. So if you allocate 20,000, you're still going to get out with 1%. If you allocate 100,000 because you have a big account, you're still going to get out of the trade with 1% the super majority of the time. About 70% of the time, or at least more than one standard deviation of the time, you're going to be able to get out of the trade with 1% without having to adjust. About 30% of the time, 30 to 40% of the time, you're going to have to adjust. So you need to know how to adjust on a high level. We'll talk about that here in a bit. but we're trying to get that 1 to 2% every single week. So in this example, we're getting $85 before fees and commissions. So we're going to have to change this up and kind of adjust the trade. We do not want to be higher than a 10 delta on either side. So this put side right now is already a 9 delta, and that's 2 times the expected move. As we record this, volatility has spiked up, so you can get further away from at the money percentage-wise and point-wise. And so we're 2 times the expected move away, and that's still a 9 delta on the put side. On the call side, we're 2 times the expected move away, and that's a 2 delta because the risk on this SPX on the S&P 500 index is skewed to the downside. So what we would do here is move up the call side closer to at the money. So let's just take this up to a 5 delta at this point. Keep it 10 points wide. And so that gives us the 115 after fees and commissions. That's still going to be more than $100. So this is how we would initiate the trade. And then after we put the trade on, we're going to do what we call put on alerts, and we're going to put a good to cancel order so that we can get filled with that 1% if we're not challenged, if we do not have to adjust. It's a process to this. But you don't want to depend on alerts. You don't want to depend on good to cancels, which they almost always work. But you want to manage this. This is not a completely sit and forget type of strategy. You have to monitor it on a daily basis. We encourage members to at least look at this 3 times a day, morning, afternoon, and evening. Look at the trade, manage the trade. You should be in tune with the trade because as the days pass, it gets closer and closer to expiration. The trade becomes more and more challenging, or and more risk is associated with the trade because of gamma risk, the rate of change of delta. Things can change fast. You can be in a good situation, then suddenly in a bad situation. You have to manage this trade and monitor it on a daily basis. So once you have set up the trade, you want to go to step number 2, and that's you want to manage or read the trade. Once you have set up the trade, you want to go to step 2, and that's how to read the trade. You want to read this trade on a high level. You want to know what we call here at the Dorian Trader the green, yellow, and red zone. The green zone, everything is fine. The yellow zone, things are getting a little challenging, a little more cautious. The red zone, it's most likely time to change the trade or adjust the trade. You do not want to trade this with, well, I think this is going to happen, or maybe this is going to happen. No, this is a quantitative approach that we have, a math-based approach. There's no playing around with this. You do not want this to be subjective. You want it to be rule-based, a quantitative rule-based process, so you can duplicate the success week after week after week. So you have to learn this. Now, step number 3, you're going to have to know how to adjust. And adjusting is the most difficult part of this 70T trade. It's the most difficult part to learn, I should say. Now, for example, if we go back to this platform here, and let's just say that you had the put side became challenged. And the put side was now a 35 delta, for example. At the Dorian Trader, we consider this the red zone. Let's say you wanted to adjust this. How do you do it? Do you do what we call a roll away and pay for it by rolling up towards the at the money, the non-tested side, which would be the call side in this example? Do you do it by rolling the trade out? Do you do nothing? What do you do with this trade? It's super important to understand how you adjust this trade at a high level. Here at the Dorian Trader, we teach 3 main adjustments that have deviations from it, but 3 main adjustments. The roll up. We consider the roll up as going towards the at the money line. You have the roll away. That is, here at the Dorian Trader, considered going away from the at the money line. And then we have the roll out. Here at the Dorian Trader, and just like with all other type of firms out there or whatever the case may be, a roll out is when you take a trade from one expiration period to a later expiration period. So with this 70T trade, that is rare. It's going to be rare for you to have to roll that trade out. Okay? It's going to be rare. It should be rare. If you're rolling out a lot, then you're not adjusting the trade at the level that you should be adjusting this trade. So number 4, you have to understand how to take the trade off. When you are doing this trade, you're setting it up as an iron condor, and then sometimes it's going to get to the point where the iron condor has a 0 bid on one of the sides. and you're going to have to know how to take it off. It might have a zero bid on the call side or the put side, and it's usually going to be on the 0 day because you had to go from 7 DTE to 0 DTE. And so you have to understand that you can't always take it off as an iron condor. You might have to take it off as vertical spreads. Just take the put side off individually and the call side individually. Or you might have to take off the short legs only on the call side or the put side. You're going to take this trade off before expiration. This is not a trade that you're going to stay in for the entire 7 days. Most of the time, you're not going to stay in this trade for the entire 7 days. Most of the time, you're going to be in this trade for 3 to 5 days. So once you get these processes down, you're going to be able to darn near print money, if not literally printing money through the amount of time you're winning. I'm not the only member of the Dorian Trader that's had this type of success. We have also another member that's had equally, if not better success than me over the last year with this strategy, winning and winning and winning. Then we have a ton of members that went 6 months, 8 months of winning on this strategy and continue to win on a consistent basis. This is a process. We have set up an apparatus for that. Anyone can learn this. You do not have to be an experienced long-term trader, but you do have to put in the work. You have to have the desire, which you do because you are watching this video. You have to have the dedication. You have to have the plan. That comes from our course. Our course sets the plan for you, sets the journey out for you. And then you're going to have the discipline. Once again, we call it the 3 Ds: desire, dedication, and discipline. You're going to have the discipline to follow through with the plan. If you do not have the discipline to follow the strategy, you will lose, and lose at times really big. But if you have the discipline, you should win 95+% of the time. You should go months and months and months with winning on this trade. And then if you follow the strategy, you have the discipline, when you lose, it should be small. I started trading this strategy in March of 2023. I went 54 weeks straight without losing. Then we lost 1 week, and it was a very small, insignificant loss. We now have been on another 52-week win streak. We haven't lost since March of 2024 now. So 106 weeks of just killing it on this trade. It's no longer luck. It's not luck. It's a systematic process. It's a quantitative process that we use to make money consistently, week after week after week. You can learn it too, but you have to have the 3 Ds: dedication, discipline, and the desire. You already have the desire. You need to form the dedication. You need to have the discipline. Let us help you with the process. It's time to make consistent money that you can count on with a strategy that is powerful. We call it the print money 7DT strategy for a reason, because you darn near feel like you're printing money. Join us. Let us help you learn how to do this. With that said, we hope to see you in the next video. Bye for now.